Hello and welcome to NDTV Profit. You're watching The Portfolio Manager, and my guest today is Madanagopal Ramu, who is the fund manager at Sundaram Alternate Assets. He manages a total portfolio of 3,900 crores, which is split into PMS as well as alternate asset funds. Madan, thank you very much for joining us on NDTV Profit today. You have a diverse portfolio which has focused on primarily large cap as well as some of the emerging companies. If I look at some of the funds that you have, the Sundaram India Secular Opportunities Fund, it has sector allocation of 39% on financial services, chemicals 16%, automobiles on 10, consumer services 10. Give me a sense of how you go about selecting your sectors and why you continue to be very bullish on financial services with 39% allocation.
Sure. Thank you, Sajeet, and thanks NDTV for giving this opportunity to interact with you guys. And so let me just step back and take you through on the investment philosophy of Sundaram Alternates, and then I link it to certain sector-specific calls that we have taken in the last, over the last 5 years or so. First thing is, if you look at, we fall into this bucket of investing into high growth stocks at a reasonable valuation, sort of a style. So that's the investment style that we have. We target actually returns closer to 15 to 17%. In a simple way to put it, we target to double the money for investors in a 4 to 5 year time period. And if investors stay put with us for a longer period, then actually they see almost a 4 to 5% sort of a jump in the amount that the AUM that they've invested with us. If you look at our portfolios from inception, they've almost given 8 times return in the last 11-year time period, which is a phenomenal compounding effect that we have brought into the investors' AUM. Now, coming into how do you really identify high growth stocks? That is where the entire crux and the if you talk about compounding, a lot of people talk about compounding, but they end up investing into large caps, only large caps. We completely differentiate from there. We invest into large cap, mid cap, small cap, wherever there is an opportunity, and we are able to find out a stock which is growing, which is a high growth potential. We take a 5-year view minimum. We look at companies where the growth potential for the next 5 years is substantially higher than the overall market growth rate. If you look at Nifty's earnings growth rate, it is closer to 10%. Pre-COVID, right now we are talking about 12% sort of earnings growth rate. So our target is, can we identify 20% growth stocks, which is a high growth stocks. So that is where the entire effort starts. And even if 1 or 2 stocks don't go well, you still end up creating a 17% sort of CAGR return for the 17 to 18% sort of a CAGR return for the investors. So that is how the framework is created. Now, if you look at in a country where we are seeing a real GDP growth rate of around 6% to 7%, not many stocks will keep on delivering more than 15% sort of a CAGR return. And not many stocks will deliver more than 20% CAGR return. If you look at last 10 years, companies which have delivered more than 20% CAGR return are hardly 32 stocks. And companies which have delivered more than 15% CAGR growth, I'm referring to earnings growth, not the returns, 15% earnings growth. Only 74 stocks have given this kind of an earnings growth.
So that brings the pool becomes very narrow for you to invest, right? In that sense.
Yeah, exactly. That is where the role of a fund manager to identify these high growth stocks comes into picture.
So give me a sense of financial services. 39% of your portfolio you've invested in financial services. Which area of financial services is more lucrative and giving you that kind of CAGR return of 15 or 20% over the last 10 years in terms of earnings?
Correct. So let me link it to this very statement that I made, that you need to identify these high growth stocks. You have to then invest into growth cyclicals. Like, for example, if India will grow at 6 to 7%, the nominal GDP growth rate will be closer to 10 to 11%. Financials, if you look at, are always a play on growth. If the growth in a country is very strong, then generally financial sector grows much higher than the growth of the country. So if you take any country like China in the last 15 years, if you look at the growth of financial space, is substantially higher than the overall GDP growth rate of China. Why this happens? Because as the income level increases, the household debt to GDP increases tremendously. In China, if you look at household debt to GDP, it is 100%. In India, it is 19%. Over the next, say, 10 years, this number can easily move to 60, 70% in India. So as the per capita income increases, more people become bankable in India. Just imagine right now, today we are talking about a nominal GDP of close to 240 lakh crores, or in dollars, it is $3 trillion. And we have just 19% of that as the household debt. If you for a moment assume that over the next 8-year time period, as we move closer to 2030, if this number of 19% moves to 50, 60%, we are talking about, and the GDP also will move from $3 trillion to closer to somewhere like $6.5 to $7 trillion by that time. On a $7 trillion, and then 50% sort of household debt to GDP, we are talking about a phenomenal growth. We are talking about almost 20% compounded growth in financial space, and particularly in retail credit. This has happened in the last 10 years also. While the corporate credit has suffered, the retail credit in India has grown at a CAGR of more than 17-18% in India in the last 10 years. So and that is what will happen in the next 10 years.
If I look at your top bets, the top 4 or 5 bets which I look at, BHEL, Navin Fluorine, Mahindra & Mahindra, Sapphire Foods, and then 5th one is a Home First Finance which comes in. If the 20% argument is holding, why don't you have the top bet as a banking and financial stock?
Correct. So I'll come to it. So rather, right now the portfolio is much more evenly weighted, but we only have, if you take CSOP, we only have 15 stocks. 15 in the 50, among the top 15 stocks will form almost 80% of the portfolio, and in that 15 stocks you will have almost 6 stocks where we have playing this story. We have Bajaj Finance, we have Home First, we have 5-Star, we have AU Small Finance Bank, and we have Cholamandalam. I'll give you a brief of each of these buckets, and you asked me about why we are playing this, right? So overall put together, we have almost 39% as you highlighted, but it is split into 6 stocks. So they are not shown in the top, but they are almost 39% of our portfolio. But the 39% weight to this particular space itself is a big call, right? And importantly, all of them are NBFCs, if you look at this point of time. While we have played banks in the past, but right now we are betting on NBFCs. Why we are betting on NBFCs? If India were to grow, as I highlighted, around 10% nominal GDP, a lot of non-bankable clients will become bankable. And first leg they will approach is NBFCs. And over the next, say, 10-year time period, we feel that this informal lending will convert into formal lending. I'll give you examples of 2 stocks that we have in our portfolio, Home First and 5-Star. If you look at Home First, it lends money to affordable housing category to clients where probably banks will not enter for the next, say, 5 to 10-year time period also. Because these are people with income which are much lesser, but sufficient for taking a loan up to 10 lakh. And the income of the family is important, not a single person in this kind of category. And Home First has branch sort of an approach, and they reach out to these clients. This cannot be lent on an online platform. This has to be lent through a branch network, and you need to visit the customer's place to estimate their income at the household level and take a call on whether to lend a 10 lakh sort of an housing loan to them. So these kind of customers have been using informal source at a very high cost of finance. So this change is going to happen in the next, say, in 10-year period, where a lot of these customers will be first accessing an NBFC. If you look at Home First, it has been growing at about 40% CAGR in terms of loan, and next 10 years, I think it can keep growing at least 25% plus. In our opinion. So if you put a 25% growth sort of a number for the next 5 years, and then say estimate their numbers, you can easily make a 20% CAGR return in this portfolio, even if you assume that the valuations can come down at some point of time. But still, we feel that current valuations are reasonable, and there is a scope for improvement there also. But just imagine a 25% growth in the asset growth translating into earnings. that itself will take care of the compounding effect for investors who come in and stay invested. 20% sort of a compounding effect is phenomenal in our opinion. And to achieve it, we need to identify such high growth stocks, and financials offer them. And given the informal lending to formal lending sort of a shift that is happening. So one is this one first, same thing at 5-star also. 5-star lends to small businesses, and the ticket size is around 2 to 3 lakhs. This is a space where banks again will not enter for a long period to come. Again, assessing their income level, income of these stores, you need to have a branch and visit the customer's place. So we have 3-4 stocks where the informal lending to formal lending shift is happening in a very in an accelerated way, which is Home First and 5-star. And we have stocks like Bajaj Finance also, where a lot of banks are trying to compete. But Bajaj Finance was the first to enter into consumer durable financing, very flexible sort of personal loans, lending to segments where the proof of income is still very difficult to establish, but they are very credible sort of businesses. And so that's what helped Bajaj Finance to grow for the last 10 years. And I think the growth might be little slower going forward, but still can be higher than 25% even for Bajaj Finance. So just look at the numbers, right? Bajaj Finance is a 2 lakh crore AUM company, while the total retail credit in India is closer to 50 lakh crores.
Give me a sense of Madan, BHEL. It's a PSU. And very rarely we have seen someone having such a big bet on a PSU in the capital goods sector. BHEL is has a good order book, but it is slow in execution as well. So how do you see that company?
So when I was analyst, when I joined Sundaram, I used to track power sector and capital goods sector. And for last 10 years, I've been negative on capital goods, particularly power sector related capital goods companies. Primarily because India stopped adding significantly, say, coal-based thermal power plants, correct? So literally India looked away from coal for a long period. But what has happened, interestingly, is the power demand kept increasing. And during COVID period, it was not visible because majority of the offices were shut, and we were operating some of the periods, even manufacturing and the retail outlets were shut. So the power demand was not visible. But last 2 years, suddenly you can see that the power demand has come back really strong. When I refer to power demand, I'm referring to the peak demand. Now people argue we can meet it through renewable energy. It's impossible because peak demand has to be met by guaranteed power, and guaranteed power comes from coal. The peak demand generally happens in the night around 7 to 9. In that period, you cannot expect solar, correct? So solar cannot be a source of supplying the peak demand. And wind also, it's not fully guaranteed. Unless we enter into a situation where we have a backup storage, which is at least 5 to 6 years away, you cannot be having a lower, your peak demand has to be met by coal demand, coal power plants. So we think there will be an urgency in the government, unless if they quickly in the next 3 years place closer to 60,000 or 60 gigawatt to 70 gigawatt sort of orders, then we will have very tough time in 2018, 2028, 2030 period. So we expect that to happen, and that is the reason after 10 years we have turned positive on power plants, particularly coal-based power plants.
Let's take this discussion after the break. We're entering into a short break, and when we come back, we'll also discuss about this emerging leadership fund, which has some interesting picks and some interesting sector allocations. Stay tuned to the portfolio manager. We'll be back after a short break. Welcome back. You're watching the Portfolio Manager, and with me is Madanagopal Ramu, who is the fund manager at Sundaram Alternate Assets. Madan, let's talk about some of the emerging leaders that you're betting on. That's a fund which you are looking at very closely, and it has roughly about 800 odd crores of asset under management. And interesting picks that you have there in that, consumer services is something which you are betting on. You have some of the other capital goods is one of them. Chemicals is one where you're doing it. So give me a sense of what's a theme like here, because Zomato seems to be the big theme for you.
Sure. Again, this comes under our 3Q framework, which is how we pick up our long-term growth opportunity stocks. In self, what we do is we mix between this long-term compounding stocks as well as we try to pick some short-term opportunistic from a 1 year to 2 year perspective also. So we play some cyclicals also in self. So you have certain stocks, but they will be mostly in the lower end of the portfolio. But if you look at the top picks, a lot of them have to do with how we pick the compounding stocks over the last, say, who have potential to grow in the next 10 years or so. From that perspective, consumer discretionary is a very important sector that we bet. We actually have one thematic portfolio dedicated only for consumer discretionary. And why we are doing this, and this portfolio invests only into consumer discretionary sector like retail, in the space like QSRs, it invests into consumer stocks related to healthcare. So what is the bet here? The bet is simply this, that as the income level increases, again, as we highlighted in the case of financial space, which is a growth cyclical, the other sector which will benefit tremendously as the per capita income increases and household income increases is how people spend in the urban centers. If you look at any country which has gone through a phenomenal growth in per capita income, the sector other than financial which has benefited is the consumer discretionary space. So people, when the urban people, their income level keeps going up, what they spend on entertainment, health, education, traveling, dining out, and all these areas. And that is what the theme is all about, and that is how we pick up stocks here. In the last, in the last 5 years or so, if you look at Trent, which is a franchisee owner of Westside, that has given us phenomenal return in this portfolio. Same thing right now, if you sit today and look at next, 5 years or so, we think a name like a Sapphire Foods, which is there in our portfolio, has a potential to deliver good returns to the investors, because the call is very simple, that the penetration level of many of these products are much lower, and as the income level increases, the spending pattern is going to shift from FMCG to consumer discretionary. And if we are betting on India growth story, it is always better to play consumer discretionary rather than FMCG, because even from valuation perspective, consumer discretionary trades similar or even slightly lower than FMCG. But from a growth perspective, they will offer you almost 20% growth, some of the stocks, specific stocks that we have picked up. And compared to FMCG, which is in the Nifty, capable of delivering not more than 10 to 12%.
So give me a sense of Zomato and FSN, exactly, or Nykaa.
I'll come to it. Zomato, Nykaa, Sapphire all falls into this category of high growth consumer discretionary companies. For example, why we bet on Zomato? Zomato, we did not participate during IPO because we were worried about the valuations. And also profitability perspective, the company was just getting into this momentum of turning profitable. Market was betting too much ahead, and things were that was a very completely different scenario where we were worried about the valuations also. But as they moved forward, the stock corrected almost to 50 rupees. That's where we started adding to the portfolio. When we picked the stock, the company was having a number of users were closer to 1.5 crores. If you look at the number of people, that in terms of penetration, if you convert it, it was less than 3% in India. If you look at in US and China, the food delivery penetration, online food delivery penetration is 30%. It's a long way to go for India in terms of penetration level. As the income level increases, you will expect many customers getting into online food delivery platforms for placing orders.
So one of the issues which the new age companies about the cash flows, Madan, are you confident about the cash flows coming back into these operations?
I'll come to it. Yes, that's exactly the point I was making. There are many other opportunities also in the e-commerce space, but we bet on Zomato primarily because we felt that profitability is possible in this space. Why profitability was possible is if you look at an average delivery, delivered delivery value, it's around 400 rupees per order. And if you look at a restaurant, it's a high gross margin business. If you look at the restaurant business, it's a high gross margin business. Almost they make 65 to 70% gross margin. Everything else is fixed cost of running a restaurant. If the same restaurant gets a delivery order, the fixed cost remains same. But on that 400 rupee additional order you get, you make almost 250, 280 rupees of profit. Now out of it, I don't think they will mind sharing 80 to 100 rupees to a Zomato or a Swiggy delivery platform, because after paying that, you still end up making 150 to 180 rupees. And 150 rupees on 400 rupees, it's still 40% sort of an EBITDA margin compared to 15% EBITDA margin that most of these restaurants operate. So, we took this bet that it is possible, and given that competition is going to be away due to PE funding drying up in the space, Swiggy and Zomato will eventually be controlling the market for the next 5 years, and therefore these guys will be slowly making a case for increasing their take rates. So now the take rates have almost increased closer to 80, 85 rupees, and also they have started charging to the customer. Recently also you would have seen they started charging again 2 rupees extra to the customers. So from a period where they were not making any contribution per order, today they are making almost 25 rupees contribution per order. Which is the growth that we are seeing, and already turned positive at the EBITDA level. The food delivery is already turned positive, and it's already making EBITDA positive numbers. It's only the Blinkit, which is a business which is in a seeding business. That will take another 2-3 years before it turns positive, and they will leverage a lot of infrastructure which Zomato is offering for them to make money in Blinkit also. But if you look at food delivery as such, it is already profitable, and the user base will easily grow. It's anywhere between 20-25%. Your order value also will keep increasing at least by 3 to 4% over a 5-year time period, and you will be able to charge both the restaurant as well as customer as the service becomes more, and more people get added to the system. So overall, these kind of companies will deliver earnings growth much superior than even 20% that we target. So that is why the stock also started reacting when the company started delivering on the profitability front, and that was the bet on Zomato. And the same is the case with Sapphire Foods. That the stock is yet to deliver good, to the extent that we would like to. But next 4-5 years, I think, given the kind of KFC store addition, even Sapphire has potential to deliver good returns to the investors. It is trading actually at a discount to many of these consumer stocks right now. Same thing with FS and e-commerce. FS and e-commerce also corrected significantly, and they started adding at around 130 levels. It's actually a profitable e-commerce business. If you look at globally, the beauty segment, the penetration levels are even higher than other segments. It is even closer to 40-50%. It's a segment where online can do well, and the user base is still around 1 crore in India. So a long way to go, and predominantly used by urban women. And we feel that beauty as a space will grow significantly, and we have seen similar ideas doing really well at the global level. So again, all these three stocks play on this growth of income, and where the customers will spend more. They will spend more on dining, they will spend more on beauty products, they will spend more on traveling. So this is the concept that we are betting. And we have another idea which is called Rainbow Healthcare, which was a bet on children healthcare. We are interested in this space, and whichever stock where the value as well as growth is very attractive, we tend to invest, and we have been very successful by investing into retail and QSRs. Westlife Development has been a great value generator for us. Trent again, Titan, all these three stocks. In the past, we used to have Jubilant Foods also. So all these stocks have delivered good returns to us in the past. So right now our picks are FS and e-commerce, which is Nykaa, and then Zomato and Sapphire. That's the bet there, and these guys have capability of beating FMCG companies from an earnings perspective, and valuation wise. Also, they are not very costly. Probably Zomato is slightly higher in terms of valuation, but if you look at Sapphire Foods and FSN e-commerce, the valuations are at a discount right now compared to the FMCG companies, but delivering superior earnings growth. That is the point.
It was a pleasure talking to you today and understanding your entire investing philosophy, especially with respect to consumer discretionary and some of the